Samsung just confirmed that their next generation electric vehicle battery requires 1 full kilogram of silver per pack. Not grams, 1 kilogram. And if you do not understand what that single number does to global silver supply, you need to watch this entire video before the rest of the world figures it out. Because right now, silver is sitting at $75 an ounce. Goldman Sachs just raised its 12-month price target. China just posted the highest quarterly silver import on record. And a $535 million Russian state reserve program that almost nobody in English language media has reported is quietly sitting inside federal budget documents. Every single one of those things is happening simultaneously. And the market is still pricing silver like it is a slow-moving industrial byproduct with no structural demand shock on the horizon. That gap between what the data is showing and what the price is reflecting is exactly what this video is about. And by the time you are done watching, you will understand why institutions are already repositioning, why China is not waiting for the West to react, and why $75 is not the ceiling. It is the starting point. Let me give you the mechanism, because the headline number alone is not enough. Samsung SDI has confirmed that its silver carbon solid-state battery architecture, the chemistry it is now moving from pilot to pre-commercial production, requires approximately 1 kilogram of silver per 100 kilowatt-hour battery pack. Compare that to the 15 to 25 grams of silver currently embedded in a conventional EV battery system today. And you are not looking at incremental demand growth. You are looking at a step function change, a 40 to 60 times increase in silver intensity per vehicle, tied to a single chemistry transition that is already happening. Now here is where it gets real. Most people hear that number and stop at the headline. Institutions run it forward. Global EV production crossed 20 million units in 2025, according to International Energy Agency data. Bank of America's conservative projection puts that number at 28 million units by 2028. If just 15% of those vehicles transition to Samsung's silver carbon architecture, that is 4.2 million vehicles per year, each consuming 1 kilogram of silver. That is 4,200 metric tons of incremental annual demand from a single manufacturer's adoption curve. Convert that into ounces, and you land at roughly 135 million ounces of additional demand per year. Total global silver mine production right now sits at approximately 830 million ounces annually, according to U.S. Geological Survey estimates. That means one partial adoption curve inside one battery chemistry consumes over 16% of total global mine supply. Not new supply, total existing supply. And that number does not yet include Toyota, which has already signed a strategic partnership targeting 2027 commercial rollout, starting with Lexus models. Pilot lines have been operational since Q3 of 2024, with reported yields approaching 80% and degradation rates under 5% after 500 cycles across extreme temperature testing. That is not laboratory theory. That is pre-commercial validation moving toward scale. By the way, if you are watching this on recession warnings for the first time, drop a comment below and tell me where you are watching from. We have viewers tuning in from all over the country and all over the world, and I want to know where this is landing. Now, step back and look at the price action in that context. Silver at $75 has moved roughly 32% year to date and approximately 11% in the last 30 trading sessions. Goldman Sachs has revised its 12-month target from $68 to $82, citing unexpected industrial tightness. But even that language understates what is actually developing, because Goldman's revision assumes a gradual demand curve. What the Samsung disclosure describes is not gradual, it is discontinuous. And discontinuities are where markets break, not drift. Here is the structural problem that most retail investors are not being shown. Silver is primarily mined as a byproduct of copper, lead, and zinc production. Roughly 70% of global silver output is not price sensitive in the short run. That means even if silver moves from 75 baht to $120, you do not get an immediate supply response. Miners are not opening new dedicated silver mines on a 6-month timeline. They are adjusting base metal output according to entirely different economic cycles, with entirely different cost structures. JP Morgan's commodities desk addressed this directly in a March 2026 note, stating that silver supply elasticity remains constrained through at least 2028 under current capital expenditure cycles. Translation: even if demand explodes, supply cannot respond meaningfully on a 24 to 36-month horizon. That is the bottleneck. That is the setup. Now, I want to show you the second fracture, because this is the part of the story that transforms this from an industrial supply squeeze into something with real geopolitical weight. And it starts with a number buried inside a government budget document that the English language financial press almost entirely ignored. Russia has allocated $535 million between 2025 and 2027, specifically for silver accumulation into state reserves. That figure sits inside published federal budget documents. It did not make mainstream headlines. Central banks historically accumulate gold. They do not accumulate silver. Silver is considered too volatile, too industrial, too secondary for reserve allocation, until now. What Russia is signaling is not simply a portfolio diversification move. It is a recognition that silver is transitioning from its historical role as a monetary metal into something more consequential, a strategic industrial input with genuine geopolitical leverage in an electrification-driven global economy. And once one central bank moves, others follow. We saw this exact dynamic in gold starting around 2018, when central bank purchases flipped from net sellers to net buyers. Gold moved from $1,200 to over $2,400 in that cycle. The structural parallel is not perfect, but the behavioral signal is clear. Citigroup published a note in February 2026 estimating that if just 3 additional emerging market central banks allocate 1% of their reserves into silver, you are looking at an additional 200 million ounces of demand over a 24-month window. That is another 24% of annual mine supply, layered on top of the Samsung demand curve, layered on top of existing solar and semiconductor demand that is not going away. Now combine all of it, the battery chemistry shift, the supply inelasticity, the central bank pivot. You are no longer looking at a tight market adjusting at the margins. You are looking at a market that is structurally breaking under simultaneous demand shocks that were not priced in 6 months ago and are still not fully priced in today. And yet the market is behaving as if this is a normal commodity cycle. This is where the futures market becomes the tell. COMEX registered silver inventories have dropped below 250 million ounces, down nearly 18% year over year. At the same time, open interest has increased by roughly 12%. More paper claims, fewer physical ounces backing them. That is the technical setup for a physical settlement squeeze. Not a retail-driven social media squeeze. A genuine industrial squeeze driven by users who cannot substitute silver in photovoltaics, semiconductors, and next-generation battery architectures. These are not discretionary purchases. They are required inputs. And when required inputs collide with constrained supply at an accelerating adoption curve, price does not adjust gradually. It gaps. Here is where it stops being just a supply story and starts being a demand crisis. Because what China is doing right now in the silver market should not be possible at this stage of the cycle. And the data that just came in is one of the clearest institutional signals I have seen in this space in years. Chinese silver imports just posted their highest quarterly total on record. In Q1 of 2026 alone, China imported over 98 million ounces of silver, a 27% increase year over year, according to customs data that did not generate mainstream financial headlines, but absolutely moved institutional positioning desks the moment it was released. Here is the mechanism you need to understand. China does not import silver at scale speculatively. It imports for manufacturing, solar panels, consumer electronics, and now, increasingly, battery technology aligned with the exact chemistry shift we discussed in the first part of this video. When imports spike at this level, it is not a reaction to current demand. It is a response to forward demand that has already been contracted. Procurement locks in before price recognition. That is not theory. That is how industrial supply chains actually work. We saw this same pattern play out in lithium between 2020 and 2022, before prices moved from $8,000 per metric ton to over $70,000. The institutions who understood the procurement signal early made generational returns. The retail investors who waited for the price chart to confirm it paid $70,000 for the same metal. Bank of America flagged this in a client note last week, stating that Chinese silver procurement cycles are now decoupled from spot pricing behavior. That is institutional language for one thing. They are buying regardless of price because they cannot risk not having supply. That is what strategic hoarding looks like in the early stages. Not panic. Quiet, systematic accumulation before the window closes. And connect that back to Samsung. If Chinese manufacturers are anticipating a broader industry shift towards silver-intensive solid-state battery chemistries, they are not waiting for the West to acknowledge it. They are front-running the supply chain. They are locking in physical ounces before the West starts doing the math. That is when the market dynamic flips from pricing current conditions to pricing future scarcity. Because once industrial users start pulling silver off the market at this scale, available float disappears, not gradually, all at once. And we are already seeing early evidence of this in London Bullion Market Association vault data. Available silver inventories in London have declined by approximately 14% over the last 6 months, even as prices have risen. That is not normal commodity behavior. Rising prices are supposed to attract supply back into the market. Instead, supply is being pulled off the market at the same time prices are climbing. That is what pre-breakout accumulation looks like in physical markets. Now let me address the price question directly, because this is where most people make the critical error. They look at $75 silver and think it is expensive because they are anchoring to where silver was trading 2 or 3 years ago. But markets do not care about historical ranges when the underlying structure of supply and demand has fundamentally changed. They care about marginal supply availability and marginal demand pressure going forward. At $75, silver is still trading well below its inflation-adjusted 1980 high of over $140. It is also still trading at a gold-to-silver ratio of approximately 28 to 1, compared to a long-term historical average closer to 15 to 1. If gold holds above $2,500 and the ratio reverts even partially toward 20 to 1, the implied silver price is $125. And that calculation does not include a single ounce of new battery demand. It is purely a ratio reversion argument on existing monetary dynamics. Layer in the demand shock and the math moves further. Goldman Sachs ran an internal scenario analysis last month modeling a 25% adoption rate of silver carbon solid state batteries by 2029. Under constrained supply conditions, their implied silver price came out at $147 per ounce, not as a speculative peak, as an equilibrium price required to ration demand. That is how commodities actually price when supply cannot respond fast enough. Price rises until demand destruction balances the equation. But here's the problem: silver faces that most commodities do not. The demand is not easily destroyed. You cannot build next-generation solar panels without silver. You cannot manufacture advanced semiconductors without silver. You cannot scale solid-state EV batteries without silver. So instead of demand softening as prices rise, you get substitution delays, project deferrals, and ultimately bidding wars among industrial buyers for whatever physical silver is still available. That is when price does not grind higher. That is when price accelerates. We saw this dynamic in palladium between 2016 and 2020. Palladium moved from approximately $500 per ounce to over $3,000, driven entirely by catalytic converter demand and a structural supply shortage that the market underestimated for years. The setup in silver is structurally similar, but operating at a larger scale with broader applications across more critical industries. Palladium was one application in one sector. Silver is multiple applications across energy, technology, transportation, and now sovereign reserve strategy simultaneously. Now let me bring in the final variable, because this is the trigger that turns an institutional story into a market-wide repricing event. Retail investors are still almost entirely on the sideline. ETF holdings in silver have increased by only 6% year to date, compared to increases of over 25% during previous silver bull market phases. That tells you something important about what has driven silver from $57 to $75 this year. It was not retail. It was not social media momentum. It was industrial demand and institutional repositioning, which means the largest single pool of potential capital, the retail investor base, has not entered this trade in any meaningful way yet. When retail enters a structurally tight commodity market, it does not trickle in. Historical flow data from JP Morgan shows that during the last major silver rally, retail inflows into silver ETFs peaked at over $1.8 billion in a single quarter. If a comparable flow event hits a market that is already physically constrained, price does not grind higher. It gaps, because there's not enough float to absorb that kind of demand without a rapid price discovery event. This is the phase transition that Recession Warnings has been tracking across multiple macro setups this year. The pattern is consistent. Structural imbalance builds quietly while price lags. Institutions recognize the imbalance and begin accumulating before it becomes consensus. Supply continues to tighten. Then a catalyst, a Samsung disclosure, a record Chinese import print, a Goldman price target revision brings retail attention to a market that is already structurally broken. And at that point, the price move is not a rally. It is a repricing, from accumulation to acceleration, from overlooked to unavoidable. And the key insight that is now priced into institutional thinking, but not yet into public awareness, is this. Silver is no longer a precious metal waiting for investor sentiment to shift. It is a strategic resource positioned at the intersection of the energy transition, the global electrification build-out, and the next generation of battery technology. That combination of industrial necessity, constrained supply, and now sovereign reserve interest is a confluence that the silver market has never seen before at this scale. That is why Russia moved first. That is why China is not waiting. That is why Samsung's disclosure changes the demand math permanently. And that is why the institutions who understand what the data is showing are not watching from the sideline. At $75, the market is still in the early stages of pricing a structural shift that takes years to fully resolve. The retail investor who waits for the chart to confirm it will be buying at a number that makes $75 look like the obvious entry it always was. The flows are already moving. The supply is already tightening. The demand is already contracted. The only thing that has not happened yet is the moment the rest of the market realizes what is already in motion. And when that moment arrives, the move will not be gradual. At Recession Warnings, we cover these macro setups before they become mainstream, because by the time they are mainstream, the opportunity has already shifted. If this breakdown was useful, hit subscribe and make sure you are here for the next one, because what is setting up in the broader commodities complex right now makes this silver story look like the opening act.